Welcome to Investinality, your go-to resource to weather all market conditions. Today we're going to be going over the PE ratio. I'll walk you through its definition, how it's calculated, some examples, and some of the limitations to take into consideration. Now let's get to it. Before we begin, I want to make it crystal clear that the content provided in this video is solely for educational purposes and should not be considered as financial advice. The views, opinions, and strategies presented herein do not constitute recommendations to buy, sell, or hold any securities or investments. Investing involves risk, including the potential loss of principal, and past performance is not indicative of future results. Viewers are encouraged to conduct their own research and consult with a qualified financial advisor or professional before making any investment decisions. The presenter of this video is not liable for any financial decisions made by viewers based on the information provided. Each individual is responsible for their own investment choices and should carefully consider their financial situation, risk tolerance, and investment objectives before proceeding. By watching this video, viewers acknowledge and agree that they are solely responsible for any investment decisions they make, and that the presenter and this channel bear no responsibility or liability for any outcomes, gains, or losses resulting from such decisions. Now let's get to it. We'll begin with the definition of the PE ratio. The PE ratio stands for the price to earnings ratio and emphasizes evaluation on a per share basis. The price is the current market price per share, and the earnings is the EPS or the earnings per share. If you want to learn more about the EPS, make sure to check out my video. I added a link in the description below. Now let's walk through the calculation of the PE ratio. The PE ratio is equal to the market price of the stock divided by the EPS. Now let's put this into practice with some examples. Imagine we have company XYZ. The market price of company XYZ is $20. Company XYZ's EPS is $2. In our formula of market price divided by EPS, we have a market price of $20 divided by an EPS of $2, leaving us with a PE of 10. Now what does this really mean? This means that company XYZ is currently selling at 10 times its earnings per share. How might this be helpful? Well, let's take a look at a hypothetical example. Imagine we have company A with a PE of 10. We also have company B with a PE of 25. Imagine these companies do the same thing and have the same number of shares. Now, company B has a PE of 25, which means that its price is currently selling at 25 times its earnings, and company A has a PE of 10. As we can see, company A is currently trading at 10 times its earnings, whereas company B is trading at 25 times its earnings. This tells us that company A can be considered to be undervalued. If company A's price increases, its PE would no longer be 10, but rather could reach 25 or more. When making this comparison, we also have to consider the concept of comparing apples to apples rather than apples to oranges. Now, when making this comparison, we have to understand that the PE does fluctuate. An example of how the PE fluctuates can be seen from this graph. As you can tell, the price and earnings change throughout the quarter. The reason that I've shown it at a quarterly basis is that many stocks give quarterly and annual data sets. The PE ratio fluctuation is due to changes in price. For example, from Q2 2017 to Q3 2017, we see there's an increase in the PE ratio. This means that given the EPS is held constant, the price of the company has increased. On the other hand, from Q3 2018 to Q4 2018, we see a decrease in the PE. This means that the price has decreased with respect to the earnings per share. Now let's consider the concept of comparing apples to apples rather than apples to oranges. Now let's consider the comparison of two companies. If company A and company B are in different sectors, then comparing their PE ratios may not be as beneficial as if we compare a company within the same sector. So for example, imagine we have a technology company which tend to have a higher PE, and we compare it to an oil company which tend to have a lower PE. In this case, we're comparing apples to oranges. On the other hand, imagine we have technology company A and technology company B. In this case, we would be comparing apples to apples. The PE ratio is helpful when comparing a company to the industry average. It's one way to see whether or not the company is overvalued or undervalued. So for example, let's look at this comparison. This company has a PE of 18.5, whereas the sector average is 16.8. In this case, the company can be said to be overvalued with respect to the market. On the other hand, imagine another company has a PE of 14.5. The sector average is still 16.8. In this case, the company can be said to be undervalued with respect to the sector average. And lastly, let's look at the example of a company which has the same PE ratio as the sector average. In this case, it could be said that the company is neither overvalued nor undervalued. Okay, now let's walk through some of the limitations the PE ratio has. Some of the limitations the PE ratio has are the price and earnings volatility. During earnings, prices are more likely to fluctuate, in which case the PE might over or underestimate the company's market value before and after earnings. Also, there's the concept of industry variability. As was mentioned, a tech company is more likely to have a higher PE than an oil company, in which case we have to remember to compare apples to apples rather than apples to oranges. There's also the concept of earnings quality. Now, I went through this in my EPS video, so make sure to take a look in the comments below. Lastly, there's the concept of seasonality. Seasonality is how well a company does during certain quarters. For example, imagine a theoretical ice cream company. This ice cream company is more likely to sell during the summer than the winter, in which case Q3 and Q4 would reflect higher sales than Q2 and Q1. Does a higher PE in Q1 necessarily mean that this company is overvalued? Well, not quite. Imagine the same company has a lower PE every single year during Q1. This means that a company's earnings per share may have been increasing with respect to a company's price, showing that this company has indeed been increasing its earnings per share, making it a potentially profitable company. And there you have it. We've walked through the definition, the calculation, some examples, and considered some of the limitations of the PE ratio. Thank you for watching. Remember to hit that like button and subscribe to our channel on YouTube. I'll have more investment terminology coming up soon. Until next time.